How to start mortgage note investing can completely change the way you think about real estate and cash flow. In this video,
I'm going to walk you through mortgage note investing step by step so you can get started with real estate investing without owning property or dealing with tenants and toilets. Why think like the bank? Most people think real estate investing means buying rentals, managing tenants, and fixing things that break. But there's another way. Own the debt instead of the property. When you buy a mortgage note, you're stepping into the bank's shoes. The borrower still owns the property, but you own the loan and collect the payments.
in this video, I'll break down what mortgage note investing is, the types of notes, where to find them, how to analyze them,
and how to manage your first deal so you can start confidently. What is a mortgage note? Whenever someone gets a mortgage, two key documents are created. The promissory note, the borrower's promise to repay, interest rate, payment amount, schedule, default terms. The mortgage, or deed of trust, the document that ties that promise to the property as collateral. As a mortgage note investor, you're buying that IOU and the right to receive the payments, secured by the real estate. You don't own the house, you own the loan on the house. That's the essence of real estate investing without owning property directly. Why investors choose notes over rentals? 3 big reasons.
fewer headaches. You manage a financial asset, not tenants and toilets. No midnight maintenance calls.
Cash flow backed by real estate. You earn principal and interest payments, secured by the underlying property.
If the borrower stops paying, you have legal rights to enforce the loan, including foreclosure.
Flexibility. You can buy performing notes for predictable income, non-performing notes at a discount for higher potential returns, or partials if you want smaller deal sizes.
If you like real estate but not landlording, this path can make more sense.
Types of mortgage notes to know. To approach mortgage note investing step by step, start by understanding the main categories. Performing versus non-performing.
Performing notes. Borrower is paying on time. You're buying predictable cash flow, best for beginners.
Non-performing notes. Borrower is behind or stopped paying. You buy at a discount and try to modify, reinstate, or foreclose. Higher upside, higher complexity. For your first deal, focus on small, performing notes. First lien versus second lien. First lien. First in line to be paid if the property is sold in a foreclosure. Safer.
Second lien. Behind an existing first mortgage, higher risk of being wiped out. As a beginner, stick to first lien performing notes for safety and simplicity.
Set your buy box before shopping. Before you look at any deals, decide what you want. This keeps you from chasing random notes. Clarify. Capital. How much are you comfortable investing in your first note? Target yield. For example, maybe 8%, 12% annually on performing notes. Collateral. Property type. Single family, small multifamily, etc. Owner-occupied versus investment property. States. Choose a few states whose laws and foreclosure timelines you're comfortable with. Write this down as your buy box. For example, first lien, performing notes, backed by owner-occupied single-family homes. Specific states only $30K, $80K, unpaid balance, target yield 9%, 11%. Where to find mortgage notes? You won't find these on typical house hunting sites. Common sources include note brokers and marketplaces. They send tapes, lists of notes showing property info, unpaid balance, interest rate, and payment history. Banks and credit unions. Some sell off loans that don't fit their portfolio. This takes relationship building but can be a strong source once you're established. Private sellers and other investors. Investors who created notes via seller financing sometimes sell them for cash. You'll find them at REI, meetups, note groups, and online communities. Funds and partials. Some note funds sell individual notes or partials, letting you buy the rights to a set number of future payments instead of the entire loan. Treat this like sourcing any other deal. Build relationships, let people know your buy box, and review opportunities consistently. How to analyze a note. 3-part framework. When you analyze a note, you're really analyzing 3 things: the borrower, the paper, documents, the property. Borrower. For performing notes, you want to see payment history, how long they've been making payments and how often they're late. Loan terms, interest rate, payment amount, and remaining term. Unpaid balance, UPB, how much is still owed. You're asking, how likely is this person to keep paying? 2. Paper review, the promissory note, mortgage, deed of trust, chain of assignments. Any modifications or forbearance agreements, confirm. The terms match what the seller represented. You're indeed buying a first lien. The chain of title for the note is clean. For your first deals, it's worth having an attorney experienced in notes review this. 3. Property. Even though this is real estate investing without owning property, the collateral still matters. Check. Estimated market value via comps, BPO, or valuation tools. Loan to value, LTV, equals unpaid balance divided by current value. Lower LTV equals more equity cushion. Condition and neighborhood via photos and street view. You want enough equity so that if the borrower stops paying and you eventually take the property back, your investment is protected. Running the numbers and making an offer. Now you turn the information into a purchase price. For a performing note, start with the loan terms. Unpaid balance, interest rate, payment amount, and remaining term. Decide your target yield. For example, 10% annually. Use a financial calculator or spreadsheet to figure out what you can pay for that cash flow to hit your yield. If you buy a note at full unpaid balance, your yield will be similar to the note's interest rate. If you buy it at a discount, your yield increases because you're paying less for the same payments. Adjust your offer based on property value and LTV payment history strength, state laws and foreclosure timelines, your overall comfort with the risk, due diligence, and closing. Once a seller accepts your offer, you move into deeper due diligence. Title search. Check for other liens or title problems that could affect your position. Document review. Confirm you have the note, mortgage, deed of trust, assignments, and full payment history. Collateral file check. Make sure everything is complete and consistent. If it all checks out, execute a purchase and sale agreement tailored for notes. Fund the purchase through an agreed closing process. Record the assignment and have the collateral file transferred to you. Board the loan with a licensed loan servicer to handle collections and reporting. Managing your first note. For a performing note, management is straightforward. Let your servicer collect payments, send statements, and handle basic communication. Monitor reports for late or missed payments and address issues early. Decide whether you'll hold the note to maturity, sell it, or sell a partial in the future. Over time, you can build a portfolio of notes that pay you monthly without you ever owning or managing the properties directly. Common beginner mistakes. Avoid these as you get started.
Chasing yield only. Don't buy a high-yield deal with weak collateral or messy paperwork.
Skipping professionals. Use a note-savvy attorney and a proper loan servicer. Jumping straight into non-performing notes. Start with simple, performing, first lien deals. Ignoring state laws. Foreclosure timelines and rules vary widely and affect risk and pricing. Here's a quick roadmap you can follow. Learn the basics and terminology. Define your buy box, capital, yield, property type, states, and note type. Build your team, attorney, servicer, and possibly a mentor. Start reviewing real deals and underwriting them on paper. Do one small, performing, first lien deal to learn the full process. Refine, then repeat with slightly larger or more complex deals as you gain experience.
If this helped you understand how to start mortgage note investing and gave you a clearer mortgage note investing step-by-step roadmap? Do me a favor, hit like so more investors see this, subscribe to the channel for more content on notes and creative real estate strategies, and tap the notification bell so you don't miss the next video where I break down real numbers from an actual note deal. Drop your biggest question about mortgage note investing in the comments, and I may turn it into a full video.